The ongoing tensions in West Asia did rattle markets through the week. However, Friday was a very different day. Friday, we had a great pullback, and finally, we managed to actually cut a lot of the losses of the last four sessions as well, even as most Asian markets failed to hold their ground, even as Europe was weak, and even as US futures were trading negative. It was India all the way. The Nifty and the sensex actually managed to gain over 1% for the week gone by, and the mid-cap index, it cut its loss. It was down 2% till Thursday. It cut that loss to just about 0.5% by the time we wound up the week. On this edition of Editors Roundtable, we will get you, of course, all the updates on the week that transpired, all the key events, and the key factors that the market is going to look out for as we step into the new one. We also will decode the benefits of the latest project financing norms that have come in from the RBI, which are less onerous than what the market was fearing. So lots coming up. I'm Surabhi Upadhyay, and with me on Editors Roundtable this week, Nigel D'Souza and Mangalam Malu, and a very special guest with us in the newsrooms, Nilesh Shah, Managing Director of Kotak Mahindra AMC. Nilesh, why you made the day? Ab to furti aa gayi. Ab to suddenly we're alive and kicking. Looking forward to this conversation.
He just came to the crease. He just came to the crease, and the crease was set before that itself. You know, the market did so well this week just by the news of you wanting to.
I think, yeah, they knew aap aa rahe hain, that's why.
If every time I visit, market will go up, I'll spend my whole life here.
What, you know, pehle kya hota tha, when there were batters from India who would go abroad, everyone would prepare a nice green top for them to get out. I think market was preparing for a nice green top for you to come, and then let's see how it's playing out. But what resilience in the market, right? If you look at it, if you told someone that last Thursday, when the peak, tensions were there between Iran, Iraq, and then what US would do, etc.
Iran, Israel.
Israel. Not yet Iraq. You would wonder, the Nifty at around 25,100, what happens then? Went all the way closer to 24,500. Yeah. And now back here, 1 week later, we're back to 25,100. So nothing really, shook the belief of the bulls. And while Israel, Iran and US continue to dominate ticker and oil holds around that $77 per barrel, where all eyes are hoping for some sort of deal that may come by, de-escalation or any sort of negotiation that may happen. If you look at Nifty, sensex, 1.5% each have moved higher. We're wondering whether there would be a tripartite agreement between Israel, Iran and US. There was definitely a tripartite agreement between the heavyweights of the index. Nifty Bank up 1.5%. Nifty IT up 1.5%. The third heavyweight, Reliance, up 2.5% this week. So that held the frontline indices. Yes, there was some give back in the broader markets. 0.4% lower for the mid-cap index, 1% lower for the small-cap index. But amidst that as well, a lot of stocks and some blue chips did extremely well this week. You had, M&M, Bharti Airtel, trend gain anywhere between 4 to 6%. Tata Motors and Adani Ports, of course, geopolitical uncertainty, export-related issues, etc. that broke down, some stocks lower. But look at these mid-caps. Aeroflex up 22% this week. Axis Cades up 21% this week. Looking at something like a Swiggy, which is up 9% this week. And decent traction for names like MCX and Avenue Supermarts as well. And among the losers, not many that lost in double digits. The one that lost in double digits had some reason behind that. So, case like something like Dream Folks, there was some uncertainty despite the management clarification coming in, down 15%. Intellect and Alembic, again, pharmaceutical and IT-related names, some of them saw 7-8% sort of losses. But by and large, what resilience is what we saw? I mean, for the next week, all eyes will be on the monthly expiry. But at the same time, could there be a deal that may be announced during the weekend?
Well, that's right. Nilesh, I want to ask you, what's your view? We are only halfway through the calendar year. And imagine we have seen Trump's tariffs. We have had geopolitical uncertainty, India, Pakistan, you have Iran as well as, Israel. And the last year, the earnings growth for India was very, very tepid. The hope is that things will pick up. But we're only 6 months into the year. And we've had so much of activity.
Because there's just so much news. Right?
How are you feeling? Are you feeling a little bit, are you drifting towards a cautious side? Or would you be more constructive on the markets?
So, Nigel, by Indian market is like a person whose one leg is in a cold water and other leg is in a hot boiling water. Oh, average temperature normal lag raha. Domestically, we are in a fine shape. Inflation low, banking sector solid. RBI pumping liquidity, cutting rates, becoming pro-growth, current account deficit, balance of payment under control. So everything on domestic side, including last quarter growth, was fantastic.
Yeah.
Geopolitical, there's too much of uncertainty. Now what will happen? Will the boiling water cool off? If yes, then we are in a good shape. If it starts boiling more, then will we notice the heat? That will all determine where the markets will go. And in terms of earnings also, last year the base was 30%. On that to deliver 10% is quite good. It's not bad number.
Yeah.
And again, next year, we should be looking at a low double-digit earnings growth, which is decent. So on that base, this kind of sustenance is a very good thing.
You spoke about the average looking good and the cold water, hot water philosophy. Market has actually done that only. Between 24,500 to 25,200, that range has somehow maintained. At some point, when the water gets a little too hot, we go to 25,400. When the water starts to look colder, we move to 25,200. When do we get out of this range? And what takes it out?
So, see, if I can convert this whole thing from a flow point of view.
Yes.
The retail investors have become so matured that whenever markets are rising and looking little expensive, it is SIP minus redemption, net flows automatically shrink. Whenever markets are correcting, it is SIP plus subscription, net flow increases. So at higher level of market, there is less money to invest. At lower level of market, there is more money to invest. Automatically, a range is getting set. Will this range change? I think it will change, but it will be a very slow process. Do we expect our markets to get re-rated from current level, where we are already at premium valuation? Ab isse upar kahan jayenge? So your earnings growth will deliver market return. Earnings growth are likely to be low double digit. Obviously, market return also will be moderate. Hence, these ranges will change, but people won't be able to notice it.
That liquidity question that he spoke about. So, you have a lot of data from the mutual fund.
Sylvie, and before you get to that, I'm sure you've crunched the data. I was up north a few months ago. I'd gone to Uttarakhand, Raniket, and I was at just outside this hotel, and we were talking, and there was a couple of people from Delhi region who they said, "Oh, Nigel, how are you? And good to speak to you and all." And as we were talking, that the guy who runs a grocery store out there, the other guy as well who's running another store, all of them were saying, let the market be. We are here for the long haul. Such kind of maturity in Raniket, out there where there is, it's still a developing place. It was so encouraging to hear. And at that point when the markets were in turmoil, and yet these guys were talking in this sort of a tone. I thought that was really heartening. Out here, sometimes we keep the money going and we say we are mature investors. But when at that point of time, when people start talking, when there was so much of uncertainty, I think that's heartening. But Surbhi, you have got a counter argument. Tell us.
No, it's not an argument. I'm just going to present data. But I think to your point, sometimes, and let me ask Nilesh about this. I think sometimes it's better, right? People sitting in Raniket are not looking at every news item, every ticker, every flow.
Yeah.
They've invested, they've forgotten. They're looking at the big picture. Yeah. People sitting here are looking at way too much information at some point.
I'll be very honest. I took a small little break last week. I didn't look at the market. I didn't see anything. Nifty was 25,100. Now you look at it, it's 25,100. So, yeah, no worries.
Therefore, sometimes that helps. But, okay, now here's, I have to ask you this question because of the numbers, to understand the numbers. On the mutual fund flows, let's talk about the good first. I picked up some data. So, of course, the last printed numbers tell us that the AUM of the industry is at an all-time high. It's crossed 70 lakh crores, in fact, 72.2 to be precise. Now, here's the interesting part. The MF AUM in India, over the last 10 years, the CAGR has been 20%. And last 5 years since COVID, it's been even better. It's 24%. And, of course, the DII-FI argument has been won by DIIs hands down. Last 12 months, total inflows are 6 lakh crores for domestic institutions. And at the same time, FPIs have battled total outflows, or they've given us net outflows of about 3.1 lakh crores. Now, that's the good part. However, I have to simply pull up the bar charts that we always look at when the monthly inflow numbers come in. And let me do that, and then I'll ask Nilesh about it. The fact is that when we talk about the net inflows coming into equity funds, from highs of 41,000, 42,000 crores that we were getting around Diwali last year, in fact, the December number was 41,000 crores, the last number that we got, the net number, it actually was just under 19,000. So that's a sort of a big fall that you cannot, ignore. So I went into the sectoral categories as well. Let's talk about large cap funds. Large cap funds were getting in January 3,063 crores. The last number is 1,250 crores. So that's halving in terms of just the monthly trends, how they're changing. Again, mid-cap funds also, mid-caps and small caps, usually the market's darlings. Mid-cap funds, 5,147 crores in January. Then 3,400, 3,400, 3,300. The last number was below 3,000, the May number. Small cap funds, again, I mean, we were peaking January 5,700 crores. The last number, it's still better than large caps and mid caps. But again, we're talking 3,200, roughly, give or take. The best number in all this is that SIP number because those SIP pillars are rock steady. 26,000 crores, 26,300, 400, 26,500. That's been the trend so far. Now, Nilesh, the question to you in this is that while we acknowledge what he's saying about the Ranikhet investor, SIPs are going steady, the firepower or just the sheer money power that was being thrown at the industry month after month, that has declined in the last 5-6 months. Is that, from a market perspective, could that at all be a risk?
Not at all. See, in mutual fund flows, there are 4 components. One is SIP, that's rising. Ekad mahina idhar udhar, but overall rising. The second one is NFO. When we launch NFO, we get a lot of money. When we don't launch NFO, there's no flow. The third one is a lump sum investment. As I mentioned earlier, people put lump sum when they believe market is cheap. They also don't put lump sum or avoid when they believe market is expensive. And finally, Surbhi, now we have 5 crore investors. They have 72 lakh crore here. They have made tons of money. Shouldn't they be spending something? May,
and
June,
boosting the earnings trajectory.
Yeah, May, June, they will be redeeming to take foreign vacation. When I can assure you that 90% of foreign vacation is sponsored by mutual funds. Because people have made money and they are going.
Planning for short-term goals, yeah.
Absolutely. So, I think retail investors have matured a lot. Whenever they believe valuations are cheap, there will be SIP plus subscription. Whenever they believe markets are expensive, it will be SIP minus redemption. But their participation in equity as an asset class will continue to grow.
But you're not worried about this slowly, 40,000, say 38 hua, then 35, then all of that, and now 18,000 plus.
Bring down market to 22,000 and see the
we hope that doesn't happen, because then that would mean that a lot of other stocks would see a lot bigger gashes. But be that as it may, you said that a lot of people are making a lot of money from the markets and thereafter they are taking vacation. So that holds on to the discretionary part of consumption. The other part of the economy is obviously credit growth, and there has been the rate cut that has come by, there has been the liquidity boost that has come by. Add to that, the RBI has actually gone ahead and eased project finance norm for banks as well. The NBFCs, Lata tells us that they will be benefiting from all of this. In fact, what we'll do is let's go across to Lata, who has broken this data down for us to tell us how the prospects are improving for the banks and NBFCs, specifically on project financing. Lata.
The draft rules on project finance were very strict. Compared to that, the actual rules which were announced yesterday, that is Thursday, are relatively easier on banks. Basically, it refers to how much you must set aside as provisioning when you give a project finance loan. Because in the past 10 years, during the infrastructure loans boom period, a lot of them went bust. Now, the RBI's move was in the draft rules that more money be set aside in good times so that even if they go bad, you can adjust. But to come to the rules say that banks have to keep a provision of only 1% for a project finance loan. The draft rules had set 5%. At the moment, banks keep only 0.4. So it's more than now what it is now, but it is much less than what the draft rules threatened. In case the projects were delayed, they are called DCCO deferment. What is DCCO? It is date of commencement of commercial operations. If it is delayed, then you have to keep an additional 0.37% of the total loan amount as provisioning for every quarter. The draft rules had said it should be 2.5%. Compared to that, again, it is lower. Then for commercial real estate, the new rules require 1.5% of the loan to be kept as provision. Again, the draft rules were 5%. Once the project becomes operational, see, under construction, you have to keep 1%. Once they become operational, the new rules say treat them as any loan and keep only 0.4% as provision. The draft rules had said even when they go into operation, you have to keep 2.5% as provision and then slowly bring it down over 5 years. So the point is the new rules which become applicable from October 1st are far simpler. What is more important, they apply only to prospective projects, not to projects which are already given. That was another thing which was pressuring bank stocks and the NBFC stocks. NBFC stocks which will also find relief because of this are PFC, REC, IREDA. But in the case of the NBFCs, just one point to note is they already provide more than banks because they have what you call ECL norms, expected credit loss norms. So for them, the change is really not much.
All right, thanks a lot for that. Lata brings a fair amount of clarity into, eased norms for project financing. Credit growth hasn't happened. And so two things which everyone watches as economic growth indicators. One is consumption growth, volume growth in consumer staples. The second is credit growth. These two factors are being tackled right now. We're still looking at signs of that improving. That hasn't happened. What is your thought?
Mangalam bhai, in FY20, listed India's total profit was 4,11,000 crore. This year it will be 18 lakh crore. Will they borrow or will they use this money to invest? So there is a huge growth in profitability and there aren't as many projects to invest into. Second, this lower credit growth is function of lesser demand rather than limited supply. Banks are flush with liquidity.
Exactly.
But there are not many people who are borrowing because one, they are making enough money and there are various factors at play. We have invested in a company where promoter said, Nilesh bhai, main kyun invest karu? One of my kid is going into restaurant business, other wants to run an art gallery. Now, clearly, the next generation is not stepping up. So, I think this credit growth is a complex phenomena. RBI and government has done their part in terms of providing liquidity, cutting rates, improving guidelines. But that ease of doing business still has to really improve further so that animal spirit in entrepreneurship comes alive.
But it is such a paradox, right? Just before we take that short break, I have to ask you this, because on the one hand, people are making money because of the markets. On the second, people aren't borrowing from banks because they're making money in the markets, and then they are spending somewhere. So some part of the market is earning, but a large part of the market is not lending because people aren't borrowing. And if people aren't borrowing to invest because their kids don't want to go into the business, there is no demand for businesses. And because there is no demand for businesses, capex is not happening. So it's such a complex mesh. Where does it...
So again, it's five blind men trying to identify elephant. One, there is improvement in efficiency. People are able to debottleneck their plant and improve the capacity. If you notice the utilization, it is still upwards of 70%. So it's not that we are facing... Plus, look at the inflation. Wholesale price inflation is in a low single digit. It just shows that there's no limitation of supply. People are becoming efficient. And despite having money, they are waiting to invest rather than rushing to invest.
Okay, we do have to take a quick break, but the discussion is going to continue. Lots more to discuss with Nilesh. We'll be back in just a bit.
Welcome back. You're tuned into Editors Roundtable, and we are joined by Nilesh Shah, who's spoken enough about markets. But Nilesh, let's, before getting into the weekend, let's talk about a couple of interesting things. The cricket match is going to start, India versus England. Hopefully, our boys are geared up. A new look India team. In that sort of a backdrop, what do you make of these IPL valuations? There was a news report that suggested that one of the players are looking at a $2 billion valuation. Your thoughts?
So one, in the private unlisted market, CSK shares are available.
Yes.
Go and corner that. Maybe you will get it at a much discount. Second, I think all this kind of new age businesses should get listed in the market. They are likely to have better growth. And by coming into the market, they'll also create alternative mechanisms or structures like this. Like we have data centers, CDMOs, EMS. Why not sports franchisee? Today it is IPL, tomorrow who knows, it could be table tennis, chess, football. This is how we will create the sporting culture. Capital market can take the risk and provide the capital for development.
That's very interesting, because among the listed players that there are already, you spoke about CSK, which is in the unlisted players, but you do have one of the...
Sunrisers.
You have Sunrisers, you have CESC Ventures, which has Lucknow Super Giants, and then you have obviously, Royal Challengers Bengaluru under United Spirits. these also aren't unlocking value immediately or at any point in the very near future. Do you think that deep value because of the IPL franchise in some of the players where the proportion of market cap versus what the IPL valuation is high, would that be an interesting bet?
So, Mangalam, to some extent, there's no activism shareholders here. We do guard governance, but we don't force activism.
Value.
We don't go for value unlocking. I think it's a question of time. A day will come, like in Western world, Indian investors will also become active and force promoters, managers to do value unlocking. Till such time, we'll have to be at the mercy of promoters to create value.
Two important takeaways for this weekend that will be food for thought for everyone. One, animal spirits have to come by. And second, shareholder activism spirits have to come by. So basically some tonic everyone has to drink so that, everything is covered.
I'll tell you who is drinking the tonic. The guys who are doing all the blocks and the trades, all these investments.
you looked at us.
Surbi looked at me. I was like,
Okay.
but what plans for the weekend?
No, before that, let me ask about the investment bankers that are on steroids or some tonic or God, I don't know what, because the block trade party, promoters selling P, selling that on non-stop. So, Nilesh, what do you think of the deals that are happening in the market, the valuations, and just essentially what's going on between this hectic buying and selling daily basis?
So, Surbi, as a fund manager, we always see silver lining in the dark clouds. If promoters won't sell, if investment bankers won't work 24/7, how will we get the supply? I'll have to buy the existing shares at much higher prices. Let the market forces prevail. Very recently, one very large PE fund CEO came to meet me and said, Nilesh bhai, please don't do cartelization. I said, have you gone mad? In my own company, I'm not unable to do cartelization between one fund manager and second fund manager. And you are telling me I'm doing cartelization with my competitor. You have no idea how we operate. We are competitive. So will there be one or two issues where we may end up paying higher price than needed? Probably.
Yes.
But there will be 10 other issues where we will extract our pound of flesh.
But in general,
let market forces prevail.
But in general, the deals that have happened, including a bat sold in ITC, there was a couple of weeks back, and so many other deals.
Mega Mart, 10,000 crore.
Vishal Mega Mart. In general, when you see not only the deals that you would have participated in, but even otherwise, are valuations still in sync, or is it getting a little?
So beauty is in the eye of beholder. FPIs are underweight India, and मैं तो हमेशा कहता हूँ सुबह को बुला शाम को घर लौट आएगा.
Okay, so he's told us about the FIs or the promoters selling and all that. He said that all those guys are in the mutual funds, they are spending on foreign vacations, etc. All those guys who are investment bankers, pocketing a hefty bonus by the end of this year.
And they become investor in mutual funds.
They become investors in mutual funds, and secondly, they're the ones who are buying these 10, 20, 30 crore flats, DLF.
Absolutely.
11,000 crore worth sales in just about 10 days of launch.
So the top of the pyramid thriving, premium consumption.
Yeah. Let's talk about something that we all can afford and something that he's also a big fan of. Movies. Are you watching any this weekend?
Now with OTT, it's all serials. I recently watched Tehran on Apple TV. Fantastic serial.
What about Sitare Zameen Par? It's not on OTT. It's only in the cinemas, and it's going to be in the cinemas for a while before it goes on anywhere.
I mean, I had a chance to watch it yesterday as well as earlier this week as well. I enjoyed it. It sends home a message. It's a family entertainer. It has a little bit of love, and it drives home a message as well. So I really enjoyed it. But disclosure, I'm fully emotionally invested in this film. Sitare Zameen Pe, I think.
In a world filled with way too much strife and way too many negative events, and the very unfortunate one that we had last week, I think the world can do with some positivity and love. And on that note, I think it's curtains on this edition of Editors Roundtable. Nilesh, thank you so much. You brightened up our Friday. Thanks for coming in. And with that, we'll take your leave. Thanks for watching. But stay tuned. News and updates continue on CNBC-TV18.